Let's pivot back to the markets now, as our next guest has been stacking up some nice returns so far this year with two of his biggest positions in Meta and in gold. His Morningstar five-star fund, First Eagle Global, is up 12% this year. It's outperforming the S&P. And Matt McLennan is co-head of global value at First Eagle Investments. Matt, it's good to have you. Please feel free to respond to anything you heard there from Harker or from the Fed on that issue today that you think is relevant. But how long has gold been your biggest position? Is it like 11% of the portfolio?
Gold has been a big position for us for a number of years, and we've owned it as a potential hedge in the portfolio. It's really there because it tends to do best in decades where equity does worst. And I think one of the things that gold has helped us with the last couple of years has been in this window of fiscal degradation that we were just hearing about. Gold has basically been a store of value where treasuries have not. And it's a critical component of our portfolio. Obviously, if it goes up in value too quickly, we'll trim some to keep the position well balanced in size, but it remains an important part of our portfolio.
So I thought that was great what you just said there. Gold has been a store of value, whereas treasuries have not. But I can't imagine during the 2010s when gold kind of went sideways for a decade. Was it also your biggest position then?
We've held a position in gold for a long period of time. And I think what you have to understand from a portfolio context is that there are going to be decades where stocks do great. And those decades may be decades where gold languishes as a potential hedge. And so when we step back from gold itself and think about its role in the context of a portfolio, what it's helped produce for us is a more resilient return stream overall, rather than us just betting on gold going up in a unidimensional way.
All right, fine. So it's done quite well, and obviously a lot of people wish that they had it. Is there a broader point, though, that you're making about how you think that stocks are going to continue to, would you say, underperform?
So when we look at markets today, and I think one of the issues the Fed has been dealing with here is it's not obvious that the economy is below trend. I mean, unemployment rates are low relative to history. Wage growth still remains high relative to history. If we look at participation rate in the economy, it's pretty high relative to history in terms of the prime age workers in the economy, and risk perception's low. Credit spreads for high yield bonds are below average, and equity multiples are above average. And so when we look at that constellation of facts and we superimpose on that the fiscal outlook and the risks that entails either to inflation or to recessionary adjustment if we try to address the fiscal imbalance, we think that the future for stocks could be a little choppier. But I think the key is to own businesses that aren't pricing too much from an expectational standpoint.